Everyone keeps asking the same question. If Russia is under historic sanctions, why hasn't its economy collapsed yet? Why does the ruble look strong, oil money still flow, and headlines feel confusing? Stay with me, because by the end of this video, you'll understand why the Russian economy is actually doing much worse than it looks, and why the real damage is only just beginning. If you're serious about understanding how power, money, and global economics really work, and how hidden systems collapse long before the headlines admit it, watch this video till the very end. This isn't surface-level news. This is how real change starts, by seeing through illusions. 1. The ruble illusion. Why strength doesn't mean health. After Russia invaded Ukraine and Western sanctions hit, the Russian ruble initially collapsed by nearly 20%. Markets panicked. Analysts predicted disaster. Then something strange happened. The ruble bounced back, hard. On paper, it even became one of the best performing currencies in the world for a while. But here's the truth most headlines missed. The ruble's strength was artificial. It wasn't market confidence. It wasn't economic resilience. It was control. First, the Russian government imposed strict capital controls, making it extremely difficult for citizens and companies to sell rubles and buy dollars or euros. Second, oil prices surged, flooding Russia with export revenue in the short term. Third, imports collapsed due to sanctions. And when a country imports less, it ironically sells fewer rubles to buy foreign currency, temporarily strengthening its exchange rate. But real currencies aren't judged by forced conditions. They're judged by free demand. Look at black market exchange rates, where people actually try to protect their wealth, and the picture changes fast. Trading volumes dropped sharply. Liquidity dried up. What looked like strength was really economic life support. 2. Sanctions and the hidden breakdown of industry beyond currency optics. The real damage shows up inside the economy. Sanctions didn't just target banks, they targeted components, parts, and technology. Take aviation. Russia does not manufacture its own commercial aircraft at scale. It relies heavily on Boeing and Airbus. Without access to spare parts and certified maintenance, planes can't be safely serviced. That means over time, fewer flights, grounded fleets, higher risks. The same story plays out in the automobile industry. Car factories shut down, production collapsed, high-tech manufacturing stalled. Despite political rhetoric about self-reliance, Russia remains deeply dependent on global supply chains, especially in high-tech sectors. Sanctions expose just how fragile that dependency really is. 3. Why China didn't save Russia. Many believed Russia could simply pivot to China and replace Western trade overnight. That didn't happen. Why? Because China needs Russia far less than Russia needs China. China's largest export market remains the United States, worth over $500 billion annually. Russia, by comparison, accounts for roughly $70 billion. Chinese companies may not be officially sanctioned, but they don't want to risk Western penalties. As a result, many have voluntarily reduced exports to Russia. Even imports from China declined, crushing hopes of a seamless replacement for Western goods. Economic power isn't about friendship, it's about leverage, and China has it. 4. Inflation, shortages, and the collapse of consumer confidence. Official Russian inflation sits around 20%. Reality, much worse. Shortages of components and goods push prices far higher in sectors like technology, appliances, and vehicles. Many products simply vanished. Consumers pulled back. Car sales plummeted. Retail spending dropped sharply. Investment confidence collapsed. When people stop spending and businesses stop investing, an economy doesn't just slow, it rots from within. 5. The silent exodus, brain drain, and capital flight. One of the least discussed but most devastating effects has been human capital loss. An estimated 500,000 Russians left the country. Among them, highly educated professionals, entrepreneurs, engineers, and investors. Around 14,000 ultra-high net worth individuals also left. People worth tens of millions or more. Many moved to places like Dubai, where Russian wealth flooded the property market almost overnight. This matters because economies aren't powered by land or slogans. They're powered by people. When talent leaves, innovation slows. When investors leave, growth dies. This kind of brain drain damages an economy for decades, not months. 6. Energy dependence. Russia's greatest weakness. Russia's economy depends heavily on oil, gas, and coal. Energy accounts for roughly 60% of government revenue. At first, high oil prices helped cushion the blow, but that advantage faded. Global oil prices began falling. China continued buying Russian oil, but at a 35% discount, using its monopsony power as a dominant buyer. Russia is also a high-cost producer, especially in Siberia. Lower prices eat directly into profit margins. Meanwhile, proposals like the oil price cap, targeting $40 to $60 per barrel, threaten to squeeze revenues even further. Energy dominance turned into energy vulnerability. 7. Europe's shift and Russia's shrinking leverage. Russia threatened to cut gas supplies to Europe, especially Germany. But here's the overlooked reality. Russia needs Europe more than Europe needs Russia. Before the war, 83% of Russian gas exports went to Europe, while Europe sourced only about 46% of its gas from Russia. Since then, Europe massively increased LNG imports from the United States, surpassing Russian supplies. Russia cutting gas hurts Europe, but it devastates Russia. Long-term, Europe is accelerating renewables and diversifying suppliers. Russia is now seen as an unreliable energy partner, permanently damaging trust. 8. Printing money, corporate exit, and a grim long-term outlook. To keep the system afloat, Russia ramped up spending. Money supply nearly doubled in a year, a warning sign of future inflation. At the same time, Western multinationals withdrew en masse. Roughly 40% of Russian GDP was linked to multinational activity. Around 5 million jobs depended on it. Yes, Russia replaced McDonald's branding, but replacing trust is much harder. Corruption, isolation, and sanctions make diversification extremely difficult. History shows sanctions don't always force political change. Iran and Iraq endured them for years. But economically, the damage is undeniable. Behind the stable ruble lies a shrinking, hollowed-out system. If this breakdown opened your eyes, don't stop here. Understanding how economies truly work gives you power to think independently, invest smarter, and question narratives. Like this video, subscribe for deeper analysis, and share it with someone who still believes surface-level headlines. Because real change starts with seeing reality, not illusions.